And hello, everyone. Welcome to our latest edition of the Petit Entrepreneurship Academy Seminar Series hosted by the Petit Institute at Georgia Tech. My name is Colleen Mitchell, and I handle events at IBB, as we all are known, and we're glad to have you all here today. We're expecting a nice crowd to welcome Christopher Seabolt. And just a quick couple of housekeeping notes. You'll notice that everybody upon entry is muted. Their cameras and microphones are turned off. And we ask if you would mind please keeping them in the off position so that we have as few disruptions as possible for Chris's talk. During the talk, you're welcome to enter any questions that you have into the chat, which we'll be keeping an eye on, and we will help curate some of those, as many as we can, at the end for Chris to answer in the last few minutes. And then for those of you who signed up for office hours with Chris after his talk, you should have all received confirmation emails about that yesterday, about your time. We're going to make it very easy. You're just going to stay right here for those, and we will just politely ask people to keep an eye on the clock, and when your session is finished, if you could move out so the next 15-minute group can come in, and we'll put that information back in the chat towards the end of Chris's talk. So thank you, and I will now hand things over to Cindy Sundell for the introduction.
Good morning, everybody. I'm Cindy Sundell. I am with the Petit Institute and also Venture Lab at Georgia Tech. And I'd like to introduce our speaker today, who is Chris Siebolt. Chris is a Georgia Tech grad. He majored in economics at Georgia Tech a few years ago, and he is also a Georgia native. Chris has 30 years of venture capital experience, 25 of those in Europe, so he brings an interesting expertise and background that we don't often get in Atlanta. He has recently moved back to Atlanta, and he is going to be part of our innovation ecosystem, and he is a Venture Lab mentor. In his career, Chris has focused on early stage ventures ranging from biotech to hardware. He has held several C-level positions in startup companies, including one biotech. He has approximately 20 deals as a VC under his belt. He's exited 10 of those startups for more than cost basis and has a lifetime internal rate of return of over 50%. He's going to be talking to us today about what venture capitalists are looking for and how to provide it. So I will be turning this over to Chris. And again, if you have any questions, if you would please put them in the chat, and we will be monitoring it and get to that at the end of Chris's talk. So Chris, I'm handing the mic to you.
Wonderful. Good morning, everyone. Bear with me one second. There we go. As Cindy said, just a bit of my background, just to repeat, I've been doing this for about 30 years. Most of it I've spent in the EU. I've done about 17 deals across 2 funds. 11 of those were seed, 6 were startups. Of those 17, I've exited 10, better than cost. Lifetime returns of funds are done C-level and startups in the EU. I've done 4 IPOs, 2 biotechs. The reason I'm telling you this is not because I want to make myself sound like some kind of expert, which is a term that I actually quite revile. The reason is the following. Basically, I'm going to start this presentation with a bit of a warning. The presentation is fully focused on VCs and fundraising. That's what most early stage companies are focused on, what entrepreneurs are focused on. However, that's not what's going to create the success story. It's not what interests most early stage founders at this point anyway. So we're going to focus on this anyway. But regardless, I can tell you that most of you who raise funding are going to fail despite this. The proof is, the issue is that there's this misconception in the industry that adding money to a company equals success. There are a lot more things that go on. So again, you're going to need to come back to these particular points later. What is venture capital anyway? It's a subcategory of private equity. It's the provision of finance to nascent businesses. Doesn't necessarily need to be technology. but it has it's sort of engendered itself to technology for various reasons. Number one, the scalability for returns, i.e., rapid growth. As a result of that, there are high cash burn rates and an emphasis on equity. But also because of the nascence of the businesses, it tends to be less focused on the fundamentals of the business, i.e. the benchmarks and the milestones that would be appropriate in later stage private equity, which tend to focus on cash flows. What do VCs want? There are two primary concerns when you pitch to a VC that need to be satisfied. First, they want to assess the risk, and second, they want to eliminate uncertainty. Risk, how do the VCs approach risk? It's compensated for in the discount rate applied. Discount rates are tied to the presumed failure rates of enterprises by the stage in question. I've put some numbers up here. These numbers, by the way, are statistical actuals in terms of what the failure rates are for deals and the target returns that would be expected. The discount rate basically translates into how much of this business do I need to own to make my target return relative to the forecast exit. Uncertainty, basically uncertainty is what don't I know about this business that I should. It's addressed through due diligence. It's obviously higher at the early stages as opposed to the later. And the complexity of the due diligence obviously increases as the company goes to later stages. The future fundamentals determine the exit assumption on which the ownership calculation is based, and these future fundamentals basically can be one of, or probably a combination of, revenue, operating profit or cash, and which would basically result in sort of a discounted cash flow back to present with a terminal value assumed, or assets. What is your patent portfolio, your brand, and your R&D personnel, which basically occurs off balance sheet. What are the deal terms that specifically address risk and uncertainty? Risk is addressed by having preferred returns, which include things like liquidation preferences and asset pledges, whereas uncertainty is basically control provisions and having milestones and KPIs for further funding. And then who are these VCs? Basically, you've got accelerators and incubators, you've got friends and family, you've got angel investors, and the three above, with the exception of perhaps the accelerators and incubators, tend to be somewhat less organized, I'll put it that way. And then you've got actual established funds, which consist of institutional VC funds, those are for return investors, and corporate VC funds, which are for strategy investors. According to stage, which is the appropriate funding what's the appropriate funding use according to stage? Seed is basically prototype. And again, I'm a bit of a dinosaur because I've been doing this for a very long period of time. And so I know that there are various terminologies for the various stages, but these are the ones that I started with, and these are the ones that I kind of. Seed is basically prototype. Can it be built? Can it be mass produced? Can you turn it into a commercialized product? Startup is MVP, minimum viable product. What does the product look like that would basically allow you to go to market? Commercialization of that product and the go-to-market study in terms of what's the market size, what's the appropriate market focus. Series A and later is basically expansion of revenue, expansion of the organization, basically creates, which requires working capital for growth. And then also, and this is a very important thing to realize, is that there is no such thing as a one-product organization. So your product is going to need to expand into further, preferably value-added products, ultimately culminating in what I refer to as the promised land, which would be the product which drives a major boom in equity value on which there would be an exit. Which investors do you target by stage? Seed is typically accelerators and incubators, friends and family, and angels. There are some VCs which play in this, but given the risks and the failure rates associated with type investing, they either don't play in it very hard or don't focus on it very much. Startups are angels and VC funds, and Series A plus are predominantly VC funds. What sort of control are you going to give up, and what kind of impact is your investor going to have? As you can see, friends and family and incubators have much less control provisions, but also much less impact. Whereas venture funds scaling up tend to have far more control and far more impact on the success of the business. What do you approach as far as your company valuation is concerned? What's the best way to deal with this? My advice to you is know how much you think your opportunity could be worth going in. You can obtain this by looking at comparable transactions, either industry direct, so in other words, other competitors that you or other players in the industry that are directly comparable, but also looking at indirect business model comparables. So, for example, what I refer to as the obliques. Do a discounted cash flow of the future value, very simple stuff. But one of the important things that I always tell my companies when they're fundraising is don't tell the investor how much their stake is worth. That's assuming that you're going to be able to create some kind of a multiple investor process down the road. But if you actually go to an investor and saying we're raising X at X valuation, sometimes you end up leaving money on the table. I have a very good example of that from August of last year, where the investor group kind of poisoned their fundraising, and we ended up being able to raise funding in the company at 2 times the value that was originally set by the initial investor group. Remember that you're going to have multiple rounds, therefore multiple dilution stakes. And remember that your founder's equity at exit is going to be an important consideration. So you need to make sure that the founders at exit have somewhere between 10 and 25% of the company, if not more. So how do you find the right investor? This tends to be kind of a luxury problem, especially in the very, very early stages, but it's important to remember that not all money is equal. Again, there are different control provisions, but there are also different interests and there are different value adds. What you want to do is you match stage to source, which we addressed slightly earlier. And also alignment of interest is helpful, i.e. you want to make sure that the investor buys into the business plan. There is a tremendous tendency on the part of guys to basically go and pitch business plans that they think will raise funding and not business plans that they tend to execute. Don't do that. Find an investor that believes in your approach, your market conceptualization, and your execution strategy. Be willing to listen, which basically comes down to the fourth one. The VCs should have some relevant skills and impact on the execution of the business model. But don't sell your VCs something that you think they'll invest in that doesn't match your strategy simply to raise financing. You're going to end up getting pigeonholed, and your milestones and your KPIs are going to be all out of whack. So what's classic VC versus corporate VC? Classic VC is focused exclusively on returns. It's characterized as smart money because at the end of the day, they're focused on strictly financial returns. Fundraising cycles, however, can wreck your day. One of the things, and I've worked for both, but one of the things you'll find about classic venture capital firms is the fact that they live in sort of 3 to 5 year fundraising cycles. And part and parcel of that is that they need to be able to show results within the portfolio during the fundraising. And that may mean that you either get exited early, in which case, you're basically, as a founder, being drug along into an exit without being able to realize the sort of more mature returns. Or you may just simply find yourself abandoned. I use Shark Tank as an example, but that's perhaps kind of weak. Corporate VCs focus on a strategic business tie-in, which they themselves can't deliver. It's basically referred to as dumb money because there's the strategic component, i.e. corporate VCs will overpay for deals because of the strategic benefit. They're evergreen funds, i.e. they don't have fundraising cycles. They can surprise you with their value-added advisory, but you also have to keep a very, very close eye on conflicts in the revenue and the disruption. A lot of corporates invest in businesses that are so-called disruptive. The voice over IP is an example. But they typically, because of the disruptiveness to their own internal revenue streams, end up not following through, and the business ends up failing. What investors might you have in a business that you haven't considered? One of the things which I've used quite often in the past is using your first customers or even your service providers as potential sources of finance. You can do this. Obviously through revenue, but you can also, in many cases, get an equity investment. There are also grants, which again I don't need to tell you guys because you're relying on this quite extensively already. But then there are also plenty of contests and such, which tends to be more relevant in the EU than it does in the US. But nonetheless, that's something I've relied on in the past as well. What do you have to have prepared for the pitch? You need a one-page teaser. You need to have a presentation, which I'll walk through later on today. And you need to have some idea of how much of your company you're willing to part with. And this is basically just simple math, how much you need to raise in order to execute the KPIs shown in your teaser and your short-term presentation, divided by how much you think your company is worth. The inevitable. It's going to happen more often than not. What do you do when you're told no? Cultivate a relationship with the VC. Don't just simply take no at face value. Ask for the reasons why. Ask for feedback. Try to cultivate a long-term relationship. If you know why they turned you down, typically it's going to have something to do with the stage that you're in, some KPI that's part of their investment strategy or their investment mandate that you haven't met yet. So a no today is not necessarily a no tomorrow. Therefore, you need to cultivate a long-term relationship. And then also ask yourself the hard questions. In many cases, that basically goes to is the market that we're targeting the right market? Have the VCs seen something that we need to perhaps pivot or address better? Are we even, should we even be doing this? And that's probably the hardest question to ask yourself, but that's an important one regardless. What do you do when they accept when they express an interest? Don't celebrate quite yet. You've got several agreements incoming. You've got a shareholders agreement and you've got a share purchase agreement, which comes in the later stages. You're going to have to sort out the articles. You're going to have to think through things like liquidation preferences and guaranteed returns. You're going to have to get some benchmarks in terms of what's available in the industry. You're going to have to understand what sort of IP lockups you're going to have to provide. Basically, you're going to need some advisors, and that means you're going to need a good lawyer, somebody who's preferably dealt with these kinds of deals before, and also you're going to need some existing angel or VC investors. If it's not within the investor group, again, there's a bit of a conflict in the start, but if you already have angels and VCs on board who've gone through this process before, rely on their invaluable experience if you have access to it. There are several myths and legends in venture capital. One is that ideas must be disruptive. I do not like the word disruptive. I've invested in several disruptive businesses in the past. What you want to be is innovative. Always be innovative. But disruptive, by definition, means that you're putting someone else out of business. You're causing someone else to lose a job. Disruptive businesses, by definition, have headwinds. Headwinds tend to basically increase risk and also compound uncertainty. Also, too, the second myth is that you're going to exit to Google, Amazon, Microsoft, some sort of other Goliath. You can make decent returns via trade sales, you don't need to be doing, you don't need to be generating 40, 50 times money, times money exits. You can basically develop these relationships. Either it's basically a vanity piece, so that the advisor can simply list you as something that they've got a feather in their cap, or there is going to be a sting in the tail when the company starts to succeed, or a combination of both. Also, too, there's this myth that investing in a company that's doing good works is a good idea. It's never sustainable. At the end of the day, returns are what makes a investment process sustainable. Fundable good works is charity. And also, too, watch out for ESOPs as a path to value for later employees. What you find is that the early stage, the first employees, exclusive of the founders, end up making quite a lot of money on a successful exit. But the later stage employees are going to see, it's going to be quite transparent to them, that they're not going to be realizing the same kinds of benefits in terms of exit value as as the early. So be prepared for for basically options are very compelling at the early stages, but they tend to be less compelling as time goes on. What sort of what sort of presentations do you need to build in order to raise VC capital? Strictly simple stuff here. Your problem is a key issue. You've basically got to convince the VC that you're a solution to a problem, not a solution in search of a problem to solve. That's one of the classic issues for technology-driven enterprises, is that or science-driven enterprises, is that the process typically works as follows. There's science, which is can we do it, which basically then goes to technology, which is can it be mass-produced, can it be produced at scale, and then it's like, well, we can do all this stuff, does somebody want to buy it? The classic sort of product development cycle is there a market for it? Can it be produced? And then how do we do it? You've got to describe your friction points encountered by the target customer base. You've got to describe how these friction points are addressed currently. Then you've got to also talk about the limitations and the failures of the way the thing is currently addressed. And then other information in regards to these friction points is necessary. Basically this would long and short be your elevator pitch, just the first page. Go into the solution. What are the key considerations here? Are you a disruptive technology, as I said, business model, or are you innovative? In other words, disruptive is Uber, innovative is Tinder. So you've got to describe your solution to the friction points. How does a solution resolve the friction points better than alternatives? Other information regarding the solution is necessary, and then address again the disruption. Here's a critical point. Market size. Basically, remember that your total available market is just simple demand for the product and service. How many people have the pain multiplied times the value of the pain removed? Your serviceable available market is the segment of the TAM that your products can reach. And then the serviceable own market is that percentage of the SAM which you want to which you basically have within your reach. Also, to consider the obliques. That is other things which basically compete with your product that need to be addressed. Simple market size analysis on the other. Simple description of the TAM, SAM, and SOM below. Competition is an important one. Again, remember your obliques, and also remember that the way things are currently done is in fact competition. And I think one of the things that companies often overlook is the fact that simply because you've added technology to a solution competing with the way it's currently done does not mean that people will pay more for it. Strengths and weaknesses of your competitors, good thing to include here. Keep it very, very simple. Pick the 2 or 3 points which you're best at and build the scatter plot, which I've shown here on the right. Got some noise in the background. What are your competitive advantages? Key considerations. Know where your competitors are stronger than you are and be honest about it. Understand, be prepared to address those verbally. That can be part of your product development cycle, but be prepared to go into this. Product, the all important. Make a simple summary of your product. Let them know what stage it's in. Describe its key features. Is it in prototype, beta, commercialized state? Again, product features. Here you detail the features you list on the previous page. Unit penetration, also unit economics. Remember that user acquisition does not necessarily equal revenue. There's plenty of business models out there that basically are loss leaders, i.e. acquiring unit scale. They're becoming a little bit more under pressure these days where funding is becoming under pressure. Open source is an excellent example of user acquisition without actually directly leading into revenue. But this is one of the reasons why your value add later down pipe becomes an important consideration. If you're basically giving away, engaging users for free, You need to be able to have a revenue argument on the value added side, which basically requires you to develop much later products in the product cycle that basically that contribute to your revenue. How do you intend to get these users? Have you actually thought about and chosen the best channel? Remember that, and I see a lot of presentations that basically talk about blockchain and AI as if it's a channel. It is not. Describe in limited detail how you're going to penetrate and dominate that market that you previously show. This is an execution slide. This is a very important one. Talking about the size of the market is all well and good, but if you show me how you're going to actually penetrate that market, what steps you're going to take, how are you going to do it, how are you going to sell into it, how many people are going to be required, what's your selling strategy, how are you going to engage with the customer, that's a very important one. Your business model. This is not so much numeric, but as much and more or less conceptual that leads to the numeric. This is your way to describe the current focus of the business, but also the promised land. Promised land basically is your product later on in the life cycle that creates the mega return, the mega exit, which is especially important in the earlier stages. Perhaps not so relevant, and not so much relevant in the later stages, because long and short, it's already on the horizon. You basically need to convince investors that you have a present and a future, a sustainable present, an opportunity present, but a massive exit potential future. And investors who see both are engaged. Also, you need to assess the downside, i.e., what happens if this market that we're approaching doesn't pan out? What's your pivot? What other things can you do with your product? It's not a single-use product. There are other things which you can do to it. Also include here barriers to entry, i.e., what keeps competition from doing exactly the same thing? It could be as simple as know-how. It could be as simple as IP. But you need to address this here as well. Then you get to your numbers. Again, you need to keep this internally consistent, i.e., it needs to reflect the descriptive above in business model. It needs to show a mix of the current focus, i.e., what product are you currently selling, with the promised land. What product is it that's going to generate this huge return for your investors? But I think you need to keep at the very beginning, you need to keep the revenue focus lean. It needs to be one area. I say one or two areas maximum, but I think it needs to basically be one area maximum in order to ensure there's not a diffusion of focus. Fundraising history, summarize past rounds, if any. Summarize your key investor names. Use of funds is another very important one. And again, detail here is quite important. Focus on your milestones. What are you raising the money for? What specifically are you going to be spending this on? Tell them how much funds you're looking for. Tell them specifically how you're going to use it. How much are you going to spend on R&D? How many people are you going to hire? How much money are you going to spend on sales, if any? If you're in the early stages, sales may be premature. And also, too, what kind of administration do you need? The way it traditionally works when you're building your use of proceeds, particularly if you're selling product, is the sales drives everything else. Sales basically drives the R&D and drives the administration. Again, only important if you're actually generating revenues. Marketing, how much is it going to cost you to basically do this user engagement strategy which you have above? Operating expenses, which is more mainly administration and R&D, and then your CapEx. There's no need to plan out the next 5 years of funding here, especially if you're in early stage. Just do the next 1 or 2 milestones. One of the important considerations as far as use of funds that I'll tell you is there's this thing which is bannered around in the industry that you're going to raise money for, and that you need to make sure that you have sufficient capital for the next 12 months, maybe 18 months. Statistically, that's not the way it's working out. What we're ultimately finding in the industry is that companies are raising, especially in the early stages, raising finance, and then they're not actually raising a round for the next 36 months, potentially. So it's probably going to be it could be as much as 3 years. In fact, statistically, it will be as much as 3 years before you raise another round. So bear that in mind in terms of your use of funds. Management team, this is you. This would be you. What's your past startup history? Don't be afraid of talking about failure. Talk about what you learned in the process. This is a critical issue, probably a more important slide when I talk to European startups, because Europe tends to focus very negatively on any failure on the part of founders. But I like founders who tend to be somewhat older, preferably in their late 30s and early 40s. If you're in your 20s and early 30s, you're not going to have much experience here. But regardless, somehow you're probably going to end up getting funded anyway. But regardless, again, if you've got some experience within another corporate, if you've got some experience in a previous startup, talk about the specifics, draw the parallels with the current situation at hand, talk about what you learned, and again, the best teacher is always failure. Advisors, this is a tricky one. It's good to have this here. Great to have people who are working with you, but you need to avoid vanity exercises. And angels often do this long past the point where their input is relevant. You'll have guys who basically, angel investors who basically wanting to have feathers in their caps want to be in your presentation for ad infinitum. There's a certain point where where these guys are not relevant, and they're going to need to fall out. Just keep the ones who basically are going to reflect well on the company and help you raise money by having their names here. Throughout the life of your company, one of the key things is seeking these advisors, whether they're board members or whether they're non-remunerative individuals that you have relationships with, but seek to develop and cultivate these relationships with prospective advisors and mentors that you can put on this page. And also, too, by accident, you're going to find these people will oftentimes create value, especially your angels. And that's basically it. I was a lot faster than I thought I was going to be. I apologize if I blew through some stuff, but in the event that it gives us a little bit more time to entertain questions.
Cindy, you're muted.
Unmute myself.